Video, I want to talk about, is it possible to buy calls and still be able to make money both ways? Buying a call is a bullish strategy, meaning that we want the price of the stock to go up for us to make money. If the stock drops when we buy a call option, we will lose money. So let's actually take a look at an example here. Today I'm going to be using SPY, ticker symbol SPY. Again, remember, all these trades I'm showing you here are just examples so you guys understand how this works, okay? So let's go into the options here of SPY. And I'm going to just leave my expiration date for January 17th throughout the whole video. But again, anytime you set up a strategy, first thing you should do is find a proper expiration date. Now, let's say I wanted to buy the call at the $399 strike. Let's say I wanted to buy this call on SPY right here. Again, right, we will make money if the stock goes up. However, if the stock drops in price, we're going to lose money. So let's actually take a look at what this visually looks like. So let's go over to option strat here very quickly. And let's go to build. And under basic, let's just go to regular long call here. Again, we're using SPY here today. And again, I'll put a link to option strat in the description below. A very great tool that allows you to visualize any options trade. So again, we were looking at the call at the $399 strike. So this is how this call will look like, right? We're going to enter for a debit, 114 for this example. The most you can lose is however much you paid, so 114. Max profit is infinite because, theoretically the price of a stock or an ETF can, theoretically go to basically infinite, right? And then we have our break even over here. So again, we can take a look at this chart here and we can see, right, as long as the price goes up, we're going to make money. However, if the price drops, we're going to lose money. So again, that takes us to the question at the beginning. Is it possible for us to still do something like this where we're buying calls, where we will make money to the upside, unlimited profit, but be able to make money both ways? So in other words, if the stock drops, still also be able to make money? And of course, the answer is yes. So let's take a look at how we would do this here. So let's go over here and let's go back to SPY now. So let's go back to Robinhood and we're still going to keep this call. Okay. Again, we're still going to buy calls like you normally would. And so we're actually going to go ahead and instead of just buying one call, we're going to go ahead and buy two calls here. And again, I'll show you guys how to modify the quantity of, how many contracts you want for each option that you choose here. But again, instead of buying just one call here, we're going to go ahead and buy two calls. Now notice that each call here, right, at the $399 strike, one call costs $116. So if we go ahead and we buy two calls, that's going to cost us $116 times 2. Or $232 here. And so that's very important that you do that math, okay? Because we're going to be using this here. So what we need to do next here is we want to switch over to sell now, right? So right now we're on buy. Now we want to switch over to sell because the key here is that we're going to buy these two calls, but we're also going to sell a call as well. And the call that we're going to sell is going to have a lower strike price than the calls that we're buying. So meaning below the call, here's the call we're buying. So below here, we're going to buy or we're going to sell, one of these calls has to have a lower strike. But what's most important here, okay, and again, this is very important or this is not going to work, is that we need to sell a call here that's going to give us a credit because remember, when you sell an option, you receive a credit. We want to find a call here to sell that's going to give us a credit that's higher, that's greater than the cost of buying the two calls. So that's where that math that we did earlier comes handy here. So remember, we said to buy two of these, it would cost $232. So when I come down here to sell the call, I need to make sure that I'm going to get more than $232 in credit. And again, that's very important. Ultimately, the reason we're doing this is because we want to enter this strategy for a credit. That's what's going to allow us to make money both ways. It is possible to enter this strategy for a debit. And if you enter the strategy for a debit, you're not going to be able to make money both ways. That's why we do the math. That's why this is a very important step. Now, if we take a look here, so again, right, a call has to have a lower strike. The first call here that would give us more than $232 in credit is the one at the 396 strike. Because if I were to sell this call, I would receive about $292 in credit, which is higher than 232, which again would mean we would enter for a credit. And then all of the ones below this would also work here. Now you kind of have to mess around, take a look at, how this strategy changes, how your break evens might change, all those things, depending on, what strike you choose here. I'm going to go ahead and choose the one at the $395 strike. So here I'm going to receive $372 in credit, which again is going to be greater than the amount I'm going to have to pay for buying these two calls. So let's go ahead and click on this. And the last thing we need to do here, because if this is all you do, this is just a call credit spread. That's not what we're looking at here today. Remember, what we need to do now is we want to buy two calls, not just one. So I'm going to go over here and I'm going to custom. And again, instead of doing just one call that we're buying, we're going to buy two calls. And so as you can see, right, now we're entering this for a credit. Very important that we enter this for a credit. Otherwise, we won't be able to make money both ways. You can already see down here, right, that you're going to be able to make money both ways. Now, since we're entering for a credit, that means we have to put up collateral, right? Because we need to put up some money, right? We can't just enter a strategy for free. So the collateral for this example is going to be about $400, as you can see there. So anyways, with that being said, let's go over to option strat now, visually take a look at what this looks like and what's going on. So let's go into a new tab here for option strat. Let's go to build. And again, we'll just go to regular long call to start. So let's go back to SPY here. Our expiration date, January 17th. So again, right, we're still buying calls here. We're buying two calls here. So we're still buying calls. So let's go ahead and do two here. But now remember, we also want to sell a call with a lower strike where the credit we're going to receive is greater than the debit we're paying for these two calls. So let's go ahead and sell a call. And again, the first one that worked for us was the one at the 396 strike. And I said anything below that is also going to work. So I'm just going to do the one at the 395 strike. And by the way, like I said, if I were to do the 397 strike where I'm entering for a debit, guess what? I'm only going to be able to make money to the upside, not both ways. That's why we do that math there. So let's go back to 395. That's the one I chose for this example. So we're entering this for a credit, $158 for this example. Max loss, 242. Max profit is infinite. And then chance of profit and then break even here. Now, a couple of things here, right? So again, we're still buying calls. We're still going to make money to the upside. On the upside, our max profit is still unlimited, still infinite, just like if you were buying a call. But now, right, the biggest change here is that on the downside, we can also make money. And the most you can make on the downside here is going to be however much the credit was. That's why we have to enter for a credit, right? So if our credit here for this example is $158, then the most we're going to be able to make on the downside is $158, which is still a pretty good amount. And I would rather make money than lose money here. So now, as you can see, we can make money both ways here. And we have our break even. So as long as SPY is above 401.42 or below 396.58 at expiration, we can make money with this example here. Now, the other thing I want to mention here, number one, you can close out of this at any time. You don't have to let it expire. You don't have to wait until the expiration date. You can close out at any time. Second thing I want to mention is changes in implied volatility. Always check what changes in implied volatility do to your strategy. So if 5E starts to go down, here's what it starts to look like. 5E goes up, here's what it starts to look like. So you can definitely see that it does change as IV changes. So don't be surprised if it doesn't exactly look like this after a couple days, because if IV goes up, it definitely changes. If IV goes down, it also changes. So always be aware of that as well. So anyways, if you guys have any questions, feel free to leave them in the comment section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.